It's good, yeah. If you look at if you take it as a standalone, a lowering of inflation is good for the economy. But I have a challenge with it. I've always had a challenge with it because of the fact that the flip side is what we're not looking at. You know, economics has always been about making a trade-off between inflation and growth. The numbers we are not throwing up and looking at essentially has to do with unemployment. The unemployment level is very, very high. Reports that recently came out shows that over 17 million Nigerians out of a possible 85 million are unemployed. I think at this point in our developmental life, these are the issues that we really need to look at. You know, when the central bank focuses essentially on targeting inflation, it means essentially that it is carrying out, executing a contractionary monetary policy. Ditto for the fiscal leg. You know, when the government is not spending as it should, to drive economic activities, when the government is carrying out huge tax drive, these are things that, they strangulate investment opportunities within the economy. So if you look at it as a standalone, it's okay. But you see, the sad thing is we have a penchant for copying and pasting things from the OECD economies, from countries like the UK, that have already got into the zenith, got into the peak. We are still scratching the surface. As an emerging economy, our focus shouldn't be targeting inflation. It should actually be, growing the economy by way of ensuring that the manufacturing sector, for example, is doing very well. A report that just came out recently from the African Development Bank shows that our manufacturing activity dipped by 41% in the last 3 years. So these are some of the reasons why you see the unemployment rate so high. So I'm not too excited about a dip in inflation. And it's going to dip further because signals coming from one of the deputy governors of the central bank indicates that they will further reduce the inflation rate because of the fact that we're heading towards an election year. So there will be a massive inflow of funds. That is fine, especially given the fact that those funds are not coming in to drive economic activities as they were. So in that regard, I would say the central bank is doing well. But overall, we've actually been, focusing in areas that we shouldn't be. I keep using Brazil as a reference point. Over a 30-year period, 1980 to 2010, they focused more on developing the infrastructure, growing the economy. There were months in Brazil where inflation was up to 9,000%. There were months when inflation was 6,000%. There were months when inflation was 4,000%. The average rate of inflation during that 30-year period was over 432%. As at June, the inflation rate in Brazil was single digit, minimum single digit, less than 5%. You see, over time, the interplay of economic forces, will come to bear, and then naturally, inflation will dip. But what has happened in Brazil, for example, is simple. Their infrastructure has developed. If you go to places like Brasilia, Rio de Janeiro, and places like the infrastructure, the development you see there were not there 40 years ago. But you see, government in, government out decided that there was a vision that they needed to drive, they needed to focus on. And that's what they did. We need to look at that strategy and see how it works for us.
Very good, OSILAMA. Now, despite the challenges you've pointed out, the single-digit target for this year, can we achieve it at this rate?
The single digit can be achieved. Like I said, because, economics is about, macroeconomics is about, you have the monetary leg, you have the fiscal leg. Now, what the central bank essentially is doing doing what other central banks globally are doing, inflation targeting. But like I said, as we are a country that we've not gotten to the point where inflation should actually be inflation targeting should be what drives us. Our infrastructures are decadent. The government can achieve whatever it wants to achieve. That is why it's a government. But the question, therefore, is what is the flip side? What's the cost benefit? What are we what are we, losing in return for achieving single-digit inflation? Or what use is single-digit inflation if the average Nigerian who wants a job, who really wants to work and be productive, doesn't get a job? Because you are emasculating and strangulating the productive sector of the economy. Like I said, if you look at manufacturing, it has dipped in the last 3 years by negative 41%, and that's not good. That's one sector that actually does engage a lot of Nigerians at different levels. And then when those people are thrown out of the safety net, a couple of other things can actually happen. So yes, that can be achieved, but it doesn't excite me because it's at the expense of growth.
Now, is there any significant impact of the current fall in inflation on the capital market? We've seen a fairly sustained bearish run in recent times.
The capital markets actually closed very high during the last quarter of 2017, up until the first quarter, or at least January of 2018. But a recent report that just came out shows that the capital market has been very, very bearish. It has dipped by, I think, about 32% as at the last report that was released. See, these are symptomatic of a whole lot of factors, some of which I've already adduced. Who are the people who drive transactions in the capital market? People who have jobs, people who have savings, and then go into investment. Savings leads to investment. A situation where the average Nigerian cannot meet his or her basic needs. You cannot be talking about investment in stock market. The stock market is a major indicator of how well an economy is doing. What you are seeing there right now, the bearish nature as it is, apart from the fact that the major foreign investors, people who send in their funds from outside our shores to invest, and then they make their profit, and there's capital flight. Even the Nigerian investors, the retail investors, they're not investing in that market because they don't have enough to meet their daily needs. So the stock market will be bearish, realistically for a while because of some of these factors that I already talked about.
All right, indeed. I know you've delved a little into this, but does the fall in inflation mean more purchasing power for the average Nigerian consumer, realistically?
A dip in inflation is actually supposed to mean more purchasing power. But that's under a ceteris paribus assumption or situation. Don't forget again, too, that food inflation actually increased by 1.37% or thereabout after the last MPC report, which means essentially that the cost of living has increased. Of course, the reverse is that standard of living has dipped. It's a whole lot of factors. The average Nigerian, again, too, the argument could be made, like I've adduced somewhere else, that what we're doing right now is we're now beginning to reap the benefit, as it were, in quotes, of what's going on in the food basket of this country, which is the middle belt. I'm talking about the farmers and the herdsmen crisis and the way it was poorly handled. And it's going to get worse. So yes, it's actually supposed to indicate a higher purchasing power, but it's not, in the real sense of the word. Who are the people who make purchases? The people who have jobs, who have disposable income. It's disposable income that translates to transactions. The unemployment rate is very, very high, and it's something that we really need to start working on. I think that should be where our focus really should be.